The Federal Reserve is expected to make several interest rate hikes this year to bring inflation under control. But how aggressive will they get, and how will higher rates affect the market and your money? Joining me now, Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. Liz Ann, thanks so much for coming in from the sunshine in Florida to join us on the show.
My pleasure.
One of the really cool things about your research is you really focus on the forward-looking indicators. What are the data telling you about inflation right now? Is there any hope it might cool down?
There is some hope. First of all, we have what I would consider the reverse base effects that will start to kick in at some point. We have to remember that what caused the initial eye-popping numbers in inflation in the middle part of 2021 was the comparison to the year prior when we were in lockdown mode and we went into that pandemic-fueled deflation era. And now, of course, as we get further into 2022, those comps go up against much hotter numbers. So we'll eventually have that going for us. If you look at ratios like ISM new orders relative to either production or inventories, those tend to be leading indicators. Those have started to roll over. So it's not universal. We still have the wage pressures. This is not an imminent decline in inflation, but looking at rate of change, that second derivative and leading indicators suggest that we could start to see an easing in pressures over the next several months.
And of course, the Fed is working on that. Now, Bill Ackman and some others have suggested that the Fed might go with 50 basis points instead of the usual quarter percentage point. And of course, everybody's speculating about how many rate hikes we'll see this year. I think the market is predicting 4, but Jamie Dimon said we might see as many as 7. What do you think?
Well, I think it depends on the data. Sometimes there's this underlying notion that I think people have when asking a question about that the Fed has a playbook and they're just deciding when to sort of drip out the information to us lowly market watchers. But the data will dictate the speed, the timing, whether they want to front end load it with a 50 basis point hike versus your more standard 25 basis points, how quickly they start QT once tapering ends. But there isn't a set playbook at this point. So it really depends on what the data says, obviously the inflation data. And some of that is driven by the virus. And that's the big wild card that none of us can try to gauge.
Well, yeah, speaking of that, what is the effect that Omicron is having on the markets and the economy right now and over the coming months?
Well, we've seen a pretty big downgrade to GDP numbers, not just for the fourth quarter, which of course is already in the books. We just don't know the reading yet. But in the first half of the year, based on whether it's consensus estimates of economists or some of the well-known economists at some of the major investment banking firms have been ratcheting down numbers. Some of that is a function of Omicron, but probably not all of it. In fact, I think if those lower numbers are accurate, I think Omicron doesn't explain all of that. I think we're actually experiencing some of what is considered countercyclical inflation, where pro-cyclical inflation you get in the early stage where rising demand causes an increase in prices. And then sometimes later in the cycle, the increase in prices starts to put downward pressure on demand and in turn growth. So I think it's a combination of Omicron and simply the fact that, as was once said about commodities more specifically, but the cure for high prices is high prices, and that is causing a dampening of demand.
Right, so it might the Fed's work might get done for it. That's interesting. I want to ask you a question that I asked Ben earlier in the show, which is, what are you looking for to decide if the recent downdraft in stocks is just an air pocket or if this is something that's the start of something more serious?
Well, we could see a continuation of what we have been seeing, which is much more weakness under the surface than what you see if you're just looking at the index level. Of course, the difference is so early in this year that we have started to feel the pain at the index level, which was decidedly not the case last year. I think the real force that matters always, not just in this cycle, is this shift from very loose monetary policy to tighter monetary policy. And that almost always ushers in bouts of volatility and weakness.
That's a great point. Look, we're out of time, but I do have to ask, can you give me maybe one sector that Schwab thinks we ought to overweight under these conditions?
Well, we are decidedly not taking a major sector approach. We think investors are probably ill-served to try to bet on a sector or two. We think factor investing makes more sense. We believe in the combination of reasonable value, still reasonable growth, kind of a quality overlay. And the one sector that checks a lot of those boxes is healthcare. And that's the one sector we haven't outperformed. But that's very different than saying we think healthcare will be a consistent outperformer of all other sectors. It just encompasses a lot of those quality factors we think that will ultimately be the leadership definers this year.
Got it. Thanks. And you might be buying at a discount right now. It's been a tough few months for healthcare. Thanks a lot, Liz Ann Sonders. Always great to hear from you.
My pleasure.